From Barangaroo Studios, the AusBiz COB is the key stuff you need to know about the day in business and finance.
Welcome to the COB this Friday the 13th. I'm Juliette Sarli, and a bit of a spooky day, if you will, on the markets today. We have not had the best session, and in fact a bit of a wobbly week. We're down 0.4%. You did see a little bit of buying coming through in the last couple of hours of trade. But we did extend from yesterday's fall, which of course was sparked by that strong jobs report, denting hopes of a rate cut by the RBA, and overnight US markets also lower. All 11 sectors lower today, with losses led by the miners, which begets to ask, where is Santa? We're supposed to be getting this Santa rally, but instead we have had a negative week. I just wanted to have a quick check on where we were over the course of the week. I think a loss of something like 1.7% on the ASX 200 over the week, about 1.5% actually. And we're about 2.5% now off those records that we saw a couple of weeks ago. Also looking at the tepid response to the DigoCo IPO. Of course, this was one of the most anticipated IPOs, in fact, in a year where we haven't had many at all, and the biggest IPO in around 6 years. Shares offered at $5 per share, and we saw them open a little bit higher, but they sort of sold off in the afternoon trade, and I'm just watching DigoCo now at $4.55, so that suggests quite a bit of a fall coming through from those who bought in on the IPO. And of course the Fed in focus. Got a big week for central banks next week, but it is all going to be about the US central bank tipped to cut rates by another 25 basis points. Andrew had a really good conversation today with CFRA, tipping that there still could be another 100 basis points of cuts coming through from the Fed in 2025. You can find that on our website, ausbiz.com.au. Let's have a quick look at some of the sectors today. I did mention that the materials space in particular bore the brunt of the selling. You've got Rio down by around 3%, Fortescue off by almost 4%. Iron ore futures falling after China pledged to increase its budget deficit, issue more debt, and loosen monetary policy to try and maintain this stable economic growth as it gears up for potentially more trade tensions with the US. Having a look as well at the uranium stocks, they all moved higher as we heard from opposition leader Peter Dutton outlining his plans to bring 7 nuclear power plants on site if he, of course, does win the federal election next year. And then having a look at the banking sector, which was mostly higher. CBA up by 0.4%. Westpac there up 0.5% at $32.09. A quick look at some of the corporate stories. Insignia Financial up an impressive 17.5%, receiving a takeover bid from Bain Capital at $4 a share. IRESS, also a strong performer, reaffirming its earnings guidance, but also more importantly saying that it will resume paying dividends. We saw Resolute Mining, though, fall. CEO Terry Holohan announcing he's taking a leave of absence until the end of January. And of course, they mentioned that they have paid or are set to pay a final payment of around $30 million to the Mali government. South 32, we saw weakness in that iron ore space, and of course lower today despite getting the backing of Western Australia's government to extend the life of its Worsley alumina project, and Rio Tinto there to expand its Rincon lithium project in Argentina for $2.5 billion. It is the first commercial scale lithium operations and has the capacity to produce 60,000 tonnes of battery grade carbonate per year. A quick look as well at DigoCo. I mentioned, of course, the IPO there, and it did add 5 cents to $5.05 in the first hour of trade, but at $4.55 today. So a bit of a tepid response though. Let's get to our Friday guest and welcome to the COB, Shane Oliver from AMP. Good to talk to you, Shane. I had a great chat with Diana earlier in the week after we heard from the RBA on Tuesday. She said you guys are still sticking to your May call, but of course that's probably been reinforced now by or validated by that jobs data that we saw yesterday.
Yeah, I guess so. I still think it's a very close call. To be honest with you, I think they should go sooner rather than later. We moved to May after the Governor Bullock's speech to CEDA, where she didn't seem to be in any hurry to cut rates. Then, of course, the GDP data, and then the easing for the more dovish bias we got on Tuesday, which suggests maybe there's a good chance that it could be February. And of course, the jobs data pushes it back the other way. So it's been a a bit of a roller coaster ride in terms of that timing. You can see that in market expectations, which after the meeting on Tuesday were factoring in something like a 65% chance of a cut in February. Now they're back to about 50%, so it's 50-50. The reason I'm a little bit, you can see there, the market sort of ramped up probabilities of cuts going into February, and also at one stage there, the market had priced in something like 2 cuts by May. That's been wound back a little bit since that meeting, obviously on the back of the jobs numbers. I guess the concern I have with the jobs numbers is that, yes, they were very, very strong, but they're very hard to square with the fact that we've got an economy growing less than 1%, and yet we've got jobs growth in excess of 2%, whether you look at employment or hours worked. And that makes me think there's something funny going on here. It could be public sector employment. It could be an aberration in the data. It's a bit hard to tell. I guess the other issue is, and you can make an argument, well, maybe the Reserve Bank should look through those jobs numbers because you do have a soft economy. Wages growth has been turning down anyway, which perhaps suggests that the so-called NAIRU, the non-accelerating inflation rate of unemployment, might actually be lower than 4 point something. It could be 4% or maybe even a little bit lower than that. Otherwise, why have we got wage growth coming down despite the strong jobs market? So I reckon it remains a close call. Our base case we've left at May, but obviously we're going to have to look at those numbers pretty closely over the next month or so. We get 2 CPI releases, we get 2 rounds of job data releases, and of course we get 2 rounds of retail sales and household spending figures prior to the February meeting, which is now more than 2 months away. So it's going to be interesting to see, but I think it is a very close call as to whether it's February or May, but we're leaving our base case as being May.
Yeah, okay. Yeah. Now, in terms of what we're looking for in, I guess, around a month now when Donald Trump takes over, you were saying tariffs and sunshine potentially, as in, should we not be so gloomy?
Well, maybe not. That was partly inspired by seeing Deputy Governor Andrew House's speech on whenever that was Wednesday night, where he gave quite a good rundown of risks around tariffs. He seemed to be leaning to a conclusion that maybe the tariffs wouldn't be as negative for Australia as many people fear. And he's obviously not concerned too much about the macro impact of direct tariffs on Australia because we don't export a lot of stuff to the US. Obviously, there will be industry and individual fallouts from that, but the big issue is the indirect impact. But the conclusion of some studies he referred to is that maybe the drag on GDP is somewhere between 0 and 0.2%. So it's not huge. And in the meantime, the impact on inflation in Australia is ambiguous. It could push it up. Alternatively, weaker demand could push it down. So in the end, I came away with the view that, yes, there is a risk there, but maybe it's not as much as we fear, although markets won't necessarily see it that way. Markets will get nervous as soon as those tariffs are announced. As we saw back in 2018, whenever Trump announced tariffs, we had falls in share markets on the day or the day after that happened. And then, of course, I found the most interesting chart that Andrew Houser had was just the comparison of sunshine hours in London compared to Sydney. Sydney, it's actually quite stable. Obviously goes down a little bit in winter, but nothing like it in London. I think on his chart, at the height of winter, London gets on average no more than 2 hours sunshine a day, whereas in our case, it's way above that. So there's lots of reasons if you're in Sydney, and it's pretty much the same for most Australian cities, to be happy. At least happier than Londonites because we get more sunshine.
Yeah, indeed. Yeah. Well, you're always happy, Shane. But one thing I thought was interesting was your, I guess, caution on Bitcoin. And this is kind of interesting. And I know that you're the economist here and not anything to do with the investment team. But AMP, it has been revealed, has invested in Bitcoin. What are you saying, though, to bear in mind regarding cryptos?
Well, we did have a long discussion internally about that. I am a part of the team which contributes to those decisions in terms of what we do on asset allocation. We had a long debate about it. In the end, I concluded that there's a good chance Bitcoin is here to stay. It's becoming a form of digital gold, if you like. Some of the people who have put their money in gold in the past now going to Bitcoin, and also other cryptos do have a clearer use case. Ethereum obviously sticks out on that front, underpinning smart contracts and potentially central bank digital currency. So So in that sense, you can't totally dismiss the space, if you want to call it that. And therefore, I thought there was a case to consider a very small allocation to it, which is what AMP has done. I think it's 0.05% of an average portfolio. But there's several things to bear in mind. And I won't go through all of them, but it is a very volatile asset. You can see in that chart that just went up there then, it is very, very volatile. That is something investors need to bear in mind. Every so often, you tend to get these 80% falls. Obviously, the line along the bottom there is a regular line. Make more sense, but I've shown it in a log scale, the red line. And you can see there that we have these huge run-ups every 4 years, roughly, and then an 80% plunge into 2011, into 2015, then into 2018. I'm just reading off the chart here, and then, of course, into 2022. Now we've had that low and we're pushing on higher again. You can also see in that chart there that the pace of gains from each low to the next low or each high to the next high has been slowing down from 39 times from the first set of highs to each other, then 17 times, then 4 times. But the point is that even if you look at that chart there, even if it goes up 2 or 3 times from the 2021 high to the next high, which could be next year, 2025, you're looking at a gain up to, say, 135,000 a Bitcoin or to 200,000 a Bitcoin, depending on how much it is, 2 or 3 times. So you are still looking at potentially strong gains from here as Bitcoin increasingly beds itself in as a digital gold investment, as you like. But as I say, from that chart, you can see the volatility. It's often twice as volatile as shares are. It is somewhat correlated with shares. When share goes up, Bitcoin tends to go up. It's impossible to value, unlike a property or a share where you can look at the rents, where you can look at the dividends. There's no such valuation metric you can apply to Bitcoin. I know some people like to pretend they can with staking and all that sort of stuff, but I think that's a bit of make-believe stuff. But it is very hard to value. So investors going into it need to go in with their eyes open. They need to have a good understanding about it. I have a rule: if you don't understand something, don't invest in it. They need to allow that it's going to be a very volatile ride, and when shares go down, Bitcoin could go down a lot more. So that's my view on it. But as I say, it does seem to be eking out a role for itself as an alternative to gold. And gold has been around for a long, long time. So Bitcoin alternatively could be around for a long, long time. And other aspects of the crypto space, other cryptos, do have potential use cases, even though I don't personally think I'll ever be using Bitcoin to undertake expenses at the shop. I don't think I'll be buying a cup of coffee with Bitcoin, for example. It's too slow and too costly to do that. But there may come a time when I'm using a currency which might be underpinned by Ethereum to do that. So it's certainly an interesting time.
Yeah, I wonder how that guy who bought 2 pizzas with Bitcoin feels when he looks at the price now. Just a quick final word, Shane, is Santa going to come? Because, we're supposed to have this Santa rally and it hasn't been a great week for markets.
No, it hasn't been, but I'm conscious Santa often comes in the week. Well, put it this way. If you look historically, December is normally a good month for shares, but the first 2 weeks can often be a little bit rougher. And I think what's happened this time around is we had those huge gains through November, both in US shares and also in Australian shares, partly on the back of Trump's victory in the US and enthusiasm around that. That left markets overbought, vulnerable to any concerns about how much the Fed's going to cut interest rates or when is the RBA going to cut rates, how much will profit pick up by. And so I think we've seen a bit of profit take here, which has led to this weakness. But Santa normally starts to come through the latter part, the second half of December, in the run-up to Christmas, and often in that period between Christmas and New Year. So historically, you wouldn't read too much into this weakness we've seen so far in the first 2 weeks of December. There's still plenty of time for Santa to come over the next couple of weeks.
All right, I've got my order in. A few Bitcoins under the tree for me. Shane, have a good weekend.
Good one.
Okay,
See you
next
too.
week.
Thanks, Julia. Take care.
Well, the stock of the day was DigoCo REIT, of course, during its IPO. We had Henry Jennings from Marcus Today and Adam Dawes from Shaw & Partners join Koshi.
Overall, it's going to have to buy these other data centres or acquire these at a really good price, and that's going to be the keys, to have that margin and get the right pricing for all of those. But then going on from that, it's all about megawatts, it's all about the usage and how much usage they're going to have. And that's only time will tell to sort of see those customers coming in and how that's going to work out. But overall, it does look like a really good idea, a deal. So I'm a hold at the moment for it, as it's just come on. We need to get some more information. We need to see the trading volumes. We need to see these things.
I would probably agree with that. I'd probably actually put a slight bias to the buy side on DigoCo. I have to say, it just gives us another option in terms of the data center market. And clearly, it's the biggest IPO of the year, so it's kind of a big event. It's come on with, I wouldn't say a flurry, but at least it's come on at a premium, which is good.
All right, let's have a look at the market leaders on a down day today, kicking it off with Insignia Financial following that $4 a share takeover offer from Bain Capital. Ventia Services rebounding after, of course, being sold off yesterday on those ACCC concerns. IRESS also a standout performer today, saying that it's going to reinstate dividends. Weebit Nano and Paladin Energy also looking good. To the downside today, we saw HMC Capital coming under pressure, off by 8%, along with quite a few of the gold players, actually. Gold slipping overnight to $2,709 an ounce as investors started to book profits. A lot of calls, though, still 3,000 is coming sooner rather than later. Let's have a look at the small end of town, and we saw Orthocell along with Airtasker, Strickland Metals, High Pages and Tavan all looking very good, while on the laggards, EQ Resources, St Barbara, Paradigm Bio, Empire Energy and Ausgold were among the laggards today. Well, having a look ahead tonight, we'll get import and export prices for November, while ahead next week it is, of course, I love saying this, MYEFO, the federal mid-year budget update coming through, expected sometime during the week. We're also getting PMIs for December. We get the Westpac Consumer Confidence Index for December, national accounts for the September quarter and private sector credit for November. While, of course, on the broader calendar, it'll all be about the Fed, expected to cut rates by another 25 basis points. Also, the Fed's preferred inflation index, that PCE price index coming through. GDP for the third quarter, retail sales as well, and then the China data dump for November. So we get retail sales, production, investment, and the 1 and 5 year loan prime rates, no change expected there. Let's have a quick look at where the market has finished the day's trade. Tried to rally hard in the last couple of hours or so, but we did finish lower. And just getting your pulse check on where the ASX 200, is down 34 points, 0.4%, so falling below 8,300 points. It's at 8,296. HMC and Bellevue among the laggards today. All right, we are going to have a weekend, as are you. Have a safe one, and of course we'll be back from Monday 9:45 Eastern. We'll see you then.